All right, thanks. I think we should get started, Debbie.
Yeah, please go ahead. That's good.
Great. Thanks. My name is Jeff Milley. I'm the head of research at Barclays. I'm pleased to chair the Young Scholars Forum. So we'll have 3 papers to be presented. You can submit any questions through the Q&A. I'm happy to represent those and or pepper in some of my own as we go through. And I think maybe what we'll do is just go, for lack of a better alternative, go in the order of which they're listed in the agenda, and start with David Chin.
Right. Let me share screen first. Can you guys see my screens? All right. Thank you very much for inviting me to this great conference. I really appreciate that. Title of my paper is Corporate ESG Profiles and Matching and the Cost of Bank Runs. This paper deals with how corporate ESG affect matching between borrowers and lenders, and how this endogenous matching have an impact on cost of bank runs, which is yield spread. Environmental, social, and corporate governance issues have been important more than ever in the corporate world. So to keep up with these trends, demand for sustainable lending is also on the rise. For example, as of September 22, 2019, major US banks with more than $47 trillion in assets signed on the UN Sustainable Banking Principles. So this example illustrates how banks have an interest in incorporate ESG factors into their lending practices. And also more US banks are deciding to scale back or divest from some controversial industries such as non-manufacturing or extraction industries. So all of these changes suggest that banks are changing the borrowers they will be associating with through their loan contract. As a result of this, there is a corresponding changes in loan compositions toward the more ESG-minded. In this paper, I present a new hypothesis that increasing demand for sustainable lending has more pressure low ESG banks into adding ESG consideration to their lending practices. So they have stronger incentive compared to high ESG banks. Low ESG banks have a stronger incentive to be associated with sustainable borrowers. However, if high ESG rated borrowers tends to match with high ESG lenders, then it will be difficult for low ESG banks to match with high ESG borrowers. So in this situation, low ESG banks are willing to provide lower interest rate to high ESG borrowers to increase the matching probability with high ESG borrowers. Let me quickly summarize the main result of this paper. This paper shows that high ESG firms are more likely to get bank loans, and their loans comes with lower yield spread. However, this favorable treatment in the loan market is mainly given by low ESG banks who wants to change their loan composition toward more ESG, but may have difficulty matching with high ESG borrowers. This paper shows a potential channel mechanism through which set of financial institutions change their sustainabilities. So using the Community Investment Act regulations, I showed that high ESG banks rather decrease their sustainability in the year of the examinations. But these financial pressures makes low ESG banks to be more sustainable. Last but not least, the evidence shows that borrowers attempt to improve their ESG ratings before getting a loan, and then they reduce the effort after getting it. For this analysis, I use Sustainalytics ESG scores as a proxy for firms' ESG reputation, and banks' loan data comes from LPC DealScan. In terms of filtering procedures, I restrict my sample to US borrowers and US lenders. And I focus my attention on the read arrangers because they take active roles in originating bank loans. And I excluded firms belonging to the financial industry and utility industry from the borrowing population by following the convention in the literature. Let me start with the first analysis on unconditional matching based on financial constraint firms. Since we don't have data on bank loan applications, we don't know whether or which firms needs bank loans. So to deal with this issue, I construct sample firms potentially seeking bank loans by using Horvath's and Maximovic's text-based financial constraint measures, which captures each firm's intention to use debt financing, which both includes corporate bonds and bank loans. So I narrowed down my sample by choosing only firms who do not issue corporate bonds in a given year to get clean estimate. In model specification, the dependent variable is dummy variable, which takes the value 1 if the financial constraint firms receive the loans in a given year and 0 otherwise. The main independent variable interest in this model is borrower's ESG scores 1 year before the matching year. I use a probability logic linear probability model in these tables. As you can see here, the coefficient on the borrower's ESG scores is significantly positive, which suggests that high ESG borrowers are more likely to get bank loans. This evidence is consistent regardless of the model specifications. I also test with the general financial constraint measure frequently used in the literature, such as Kaplan-Zinger's weighted own and HP index, and results still hold at the 1% level. This section, I test whether lenders are more likely to match with the borrowers having similar ESG credentials. In model specification, the dependent variables borrowers' ESG scores and main independent variable interest in lenders' ESG profiles before new loan originations. To fully control the impact of relationship lendings on matching, I only use the very first transactions between the lender and the borrower. This table shows that coefficient on lenders' ESG is significantly positive, which means that high ESG lenders tends to match with high ESG borrowers. This finding suggests that low ESG banks may have difficulty matching with high ESG borrowers. That's why they are willing to provide low spread premium to high ESG borrowers to increase the matching probability with them. Let me move on to the loan pricing analysis to study the impact of the borrower's ESG on loan spread. The dependent variable local loan spread and the main independent variable is borrower's ESG scores. X is the borrower characteristic, which includes total asset, marketable cash, leverage, and S&P credit rating. And Y is macroeconomic variable, which includes term and credit spread. And Z is the loan characteristics, which contain proxies for relationship lending, loan amount, maturity, collateral, loan purpose, and loan type. Industry borrower and lender fixed effect are controlled for in the model, and scenarios are clustered by borrower in year. What I find is the evidence on borrowers' ESG is significantly negative, which means that high ESG borrowers get favorable interest rate in the loan market. Potentially another interesting pattern is if you look at the columns 3 and 4, the coefficient on relationship strengths, which is defined as the number of transactions between lender and borrower pair since their first transaction, is significantly negative, which means that more relationship is associated with decrease in loan spread. If I split the entire sample into high ESG banks and low ESG banks groups, the favorable treatment in the market we just saw in the previous slide is only given by low ESG banks. This pattern is significant and robust. Another interesting pattern is that ESG subcomponent analysis shows that all of these effects are mainly driven by environmental and social components. I do not find any significant findings with corporate governance factors. The loan pricing result we just saw are further supported by FTSE US index rebalancing data. Firm is included in the index if they meet satisfy certain ESG criteria by Fitch, otherwise excluded from the index. The evidence shows that FTSE certification effect is to lower the loan spread, but reduction in loan spread is weaker as banks' ESG profile gets higher. I also test robustness tests using the FTSE4Good US index membership data. The evidence shows that only low ESG banks provide lower interest rate to US FTSE4Good member funds. And my calculation shows that the index membership status lowers the mean spread by 17.1%, which amounts to $3.6 million per year per each loan contract. The one figure in my table compares the differences in the ESG profiles between the two banks groups. And then the differences between the ESG profiles between the two banks group have been decreasing over time. This pattern suggests that compared to high ESG banks, low ESG banks are more likely to incorporate ESG consideration to their lending practices. So their loan composition also having changed to more ESG minded. In this paper, I also provide potential channel mechanisms through which financial institutions change their sustainabilities using the Community Reinvestment Act. The evidence shows that high ESG banks lower their ESG profiles in the years of the examinations, but these financial pressures makes low ESG banks to be more sustainable. And also, this paper shows that borrowers invest in ESG effort just before getting a loan, and their ESG ratings show partial reversion afterward. In other words, they reduce the effort to improve ESG after getting a loan. Now, let me conclude my presentations. This paper shows that high ESG funds are more likely to get bank loans, and their loans comes with lower yield spread. And this lower spread is only given by low ESG banks who wants to change their loan composition toward more ESG, but may have difficulty matching with high ESG borrowers. And this paper shows that government's regulation is potential one channel mechanism through which banks change their sustainabilities. And also borrowers improve their ESG ratings before seeking a loan, and then they reduce that effort after getting it. Thank you very much.
All right, thank you. That's just as a reminder, anybody can push questions through, but we'll go on to the next paper, which I think will come from Ghassan Benmir.
Perfect. So let me share my screen. Okay. So, well, thank you very much for having us here today and giving us this opportunity to be presenting in this amazing session. So I'd like to thank the chair and the chair of the session also for accepting to be with us here today. So I'm Ghassan Benmir, and I'm a PhD student at the LSE, and this is a co-authored work with Jocelyn Romand, who's actually being in the job market in the next December. So if these topics are of interest, be on the lookout. So our paper is Policy Interaction and the Transition to Clean Technology. And without further ado, let me just probably summarize what's our main question and what we really are doing in this paper. So what we're really interested in is the dynamics and the linkages between macroeconomics, finance, and climate, and more specifically, what are the implications of fiscal environmental policy with respect to the macrofinance sphere. So as a motivation of our work, having the target of the 2 degrees Celsius or 1.5 degrees Celsius with respect to the pre-industrial level to not go over, that would require a major decrease in terms of the emission that we have as a flow every year. And this is what we can see in the bottom figure in the left bottom hand side. So requiring a major drop in emissions is quite difficult to achieve, and therefore a lot of work has been done in the literature since the 90s. And one way to achieve that is to use an optimal fiscal policy with respect to just letting the economy grow without any fiscal policy to address the externality problem. The problem by having an optimal environmental policy is that it's not able to contain the temperature below the 2 degrees Celsius. And this is in one of the conservative scenarios from the paper of Golosov and al. 2014. And as the optimal policy is not able to do that, policymakers are faced with this two different scenarios, either having a carbon price that would increase by putting in place a carbon tax that would be significantly increasing over time to keep emissions under a specific target, or to use a cap and trade system where we put quotas and therefore we're able to reduce the quotas over time and reach the net zero target of emission flow. Most of the major economies, developed economies, opted for a cap and trade system. In our work, we focus on the ETS-like system, but we can find the same in Canada, in California, in the US, for instance. And having a cap and trade system would inherently give us a price of carbon that we can see through the historical data that has been increasing, reaching 50 tons of carbon, of CO2 today, while it was 10 around 2013, if we only take the third phase. And we can expect it in the green line to keep increasing in order to reach the net zero targets that are quite important for the EU, for instance. And another specificity of this sort of ETS trading scheme is that there is a lot of volatility in the price, as we can see in the graph. So those are the two components in the design of the system that we're interested in looking at and seeing what implications they might have. So where we stand today is we need an aggressive fiscal policy to meet the climate goals. We can't rely necessarily on optimal policy that would maximize the welfare. That would have substantial costs, therefore, both for firms and households alike. And what we would like to understand, would this also propagate and have implications for the financial and monetary sector? And therefore, what is the willingness of the financial authorities to take part in this challenge? So really the main objectives that we have is to bring together macroeconomics, finance, and climate under one unified framework to first better understand the linkages and to find the better design for policies in order to tackle the climate externality. So evaluating different macroeconomic and financial implications is what we will be doing in both scenarios of the Paris Agreement and the new scenario of the of the European area, which is the net zero target, meaning by 2050, we want basically to have zero emissions. I'm saying it more in an easy way. And finally, assessing the role of macrofinancial policies in the climate mitigation strategies. So the main takeaways are implementing a fiscal policy in the spirit of the European trading system, what used to be called the European trading scheme, is costly in terms of welfare on one hand for the households, as it will be more aggressive than the optimal policy. And on the other hand, the uncertainty and the volatility that stems from the carbon trading scheme market have some implications on risk premia, which could alter the functioning of monetary policy. And as we have these two distortions that basically are inherent to the design and the needs of the stringency of the policy, we suggest and propose a use of a weighted macroprudential policy that would favor the green sector over relatively to the dirty sector, and therefore would boost the welfare as the green sector is less carbon intensive. And on the other hand, using quantitative easing rules on the monetary side to offset the volatility price transmission in the carbon ETS in the risk premium, and therefore which could distort the monetary policy transmission. In a nutshell, I won't go into any equations in this presentation, but I will just probably put the framework of and the design of what we do. So what we do is we have households that consume, invest, and save, quite standard. We have financial intermediaries, where these financial intermediaries, they receive the deposits, but on the other hand, they're able to make loans for both green and dirty firms alike and receives risky returns from both the green and the dirty firms. And finally, we have authorities, and under these we have fiscal authorities, we have financial authorities, and we have monetary authorities, where we are able to set fiscal environmental policy like the cap policy. We have a macroprudential policy and a quantitative easing policy and non-conventional monetary policy, respectively. So now I'll just probably summarize our findings with respect to the welfare and how we're thinking about it in this framework. So in this framework, as I said, since we're not able to rely on optimal environmental policy, and we have a very important goal by 2050 of a net zero emission, which translates to a 55% emission reduction by 2030, we will need to rely on a very aggressive environmental and fiscal policy. By doing so, the moment that we don't rely on optimal policy, that creates a welfare distortion. And what we show is that this welfare distortion that is inherent to the design of the policy could be tackled through a macroprudential policy. And this macroprudential policy would favor the green sector over the dirty sector, and therefore would be able to offset part of the distortion that we have on the welfare. In a numerical simulation where we consider a deterministic trend of about 0.8% of economic growth, which was the last 20 years European zone growth rate, and we have volatility, so this is the mean volatility of the ETS carbon price over the period, we're able to construct the business cycle volatility over the deterministic trend for both the optimal policy case and the cap policy that would allow us to reach the 55% decrease in emissions. We can see that the gap is quite important, as the optimal policy does not allow us to reduce emissions as we would like to. And that would be basically yielding 1% of output loss when using the stringent environmental policy. This, in other ways, translate to a loss in welfare that will be increasing in percentage deviations with respect to the optimal case. And also, we can expect that the carbon price will be also increasing in differences with respect to the optimal case in order to reach the goals of emission reduction. To offset this welfare loss, we investigate sectoral macroprudential weights that would basically lower the risks on the green firms and therefore boost green capital and therefore boost the green output. And this is exactly what we saw. So the consumption from the third column with respect to the second optimal policy is decreasing with a cap policy. However, under the presence of a macroprudential policy that favors the green sector, we're able to increase it a bit. We are not able to completely offset the welfare loss, but we're able to do it in a way where we don't create a financial bubble, because otherwise favoring only the green sector could potentially lead also to financial bubbles. So the policy implications are that the fiscal pathways consistent with reaching the net zero goals are they need a very important fiscal policy, and that would lead to welfare loss. And this welfare loss, we could offset it by using some macroprudential policy that would favor the green sector over the dirty sector. However, probably as a practical question that arises is the challenge is in identifying what green firms would be in practice. And this would be also a major concern. So might be needed to tackle before we put in place a policy such the one we are suggesting. Moving now to the other component, which is the risk premia, which we identify as the difference between the returns on capital and the riskless assets. Well, what we show is that the return on capital, so the risky assets, are impacted by four components. So the marginal input costs, the production, the output, the capital, and the relative price. And what we show is that when there is shocks, positive shocks, and symmetrically negative shocks on the carbon price, that transmits to an increase in the marginal cost, which increases the risk premium. So one way to offset it is by acting on the relative price and therefore suggesting that we could work on non-conventional monetary policies such as quantitative easing in order to restore the equilibrium, as risk premium could alter the transmission of monetary policy. So it gives also sort of like a motivation for central banks to take part in this climate topic. So this is our proposition, is to use a macroprudential rule that would react to these changes of risk premia that are inherent to this sort of market price volatility, which comes from the market design of the cap and trade system and the inefficiencies that comes with it. So this is a numerical simulation. Again, we take the mean volatility over the period of the carbon price, and we simulate a positive shock of this for this volatility. We show that for both the green risk premium and the dirty risk premium in the blue line, that increases. So when we have a positive shock, it increases by about 20 basis points. And that quantitative easing is able to completely offset the volatility increase by only using about 1.5% of asset purchase, both in the green and the dirty sectors. So as policy implications, again, implementing a market for carbon permits generates uncertainty and volatility in the carbon price. That comes through the variations in the marginal cost, which we could offset using a non-conventional monetary policy that reacts to changes in the risk premium. And finally, what we run is also a scenario for green quantitative easing. And what we show is that central banks, they have no incentives in engaging in green quantitative easing as long as the two sectors are perfectly substitutable in some ways. So the fact that they're perfectly substitutable makes it that they have no incentives in engaging in either green or dirty QE. So there is no difference for them. However, we can break this perfect substitution by introducing some macroprudential policies. Some other colleagues use different quadratic costs to emphasize the differences between the two sectors. But a macroprudential policy, when is present, we show that it's able to completely change and give an incentive to central banks to engage in quantitative easing. Again, that would also be a sort of a trade-off between higher output and lower emission, and that's the trade-off that the central bank would be able to take in this sort of framework. So that's, as I summarized in terms of policies implications, again, banks see green and dirty assets as perfectly substitutable. Therefore, no difference between engaging in dirty or green QE. However, by having a macroprudential policy that favors the green sector, they would have a better incentive to engage in green QE, but that would lead to a trade-off between higher output or lower emission to output ratio. So the main takeaways, before I hand it to my other colleague, a suboptimal policy is needed. However, it induces two inefficiencies, a welfare loss and a risk premium distortion. And finally, we should, using macrofinancial tools, could help dampen these effects. In one hand, sectoral macroprudential weights that favors the green sector is able to reduce the inefficiency wedge on welfare, while using quantitative easing is able to eliminate risk premia, and that macroprudential policy is indeed needed in order to give an incentive for central banks to engage in green quantitative easing. And by that, I would like to thank you.
Great, thank you. And good timing. And we'll turn it over to Paranitha.
Thank you so much. I will share my slides. Great. Thank you so much, everyone, and to the conference organizers for including me in today's program. So my project is called Underwater Underwriting, Bank Screening and Credit Rationing in Flood Zones. The motivations here are that floods have caused hundreds of billions of dollars in damage over the last few decades. And we know that because of climate change, these costs are likely to grow as we get rising sea levels and stronger hurricanes. And there are a lot of causes for concern about this. For example, 20% of the population in Florida and Louisiana live in flood zones. So a big question for us in finance concerns who actually bears this flood risk. And the reason this is important is because the extent to which market participants react optimally to flood risk can depend on who's actually paying for it. And so there's sort of a few different groups that we think could be bearing this risk. The first is obviously the households who choose to live in flood zones. It could be the banks that are lending to them. And this could be a problem to the extent that that flood risk is not truly reflected in the mortgage contract. or it could be through the borne by the government. And there are potentially large exposures through the government flood insurance program. So just to give a sense of some numbers, banks are lending $200 billion in flood zones, which represents roughly 10% of their total equity capital. The government underwrites 5 million flood insurance policies every year, which represents coverage levels of 1.3 trillion. So we're talking here about exposures that are potentially quite large. So that's what I'm going to tackle in my paper. The key question I'm going to ask is, how do lenders manage their exposure to flood risk in the presence of this government flood insurance? And what I'm going to do is I'm going to use a reduced form empirical design that employs a novel data set that I've constructed, which addresses a few different concerns related to data and measurement, the possibility of endogeneity from unobserved amenities in flood zones, and the possibility of endogeneity from selection who chooses to insure. So in particular, I'm going to look at two particular sources of variation. I'm going to look at a natural experiment that comes from the release of updated flood maps that change people's assessments of flood risk. And I'm also going to look at variation and banks' exposure to flood risk that comes from strict flood insurance coverage limits. Basically, flood insurance only covers up to $250,000 in flood damage. So the bank's incentive to screen will depend on whether or not they can be completely insured or not by flood insurance. So using these complementary approaches, I have two key findings. My first key finding is that banks require higher down payments or equivalently lower loan to value ratios in flood zones when they are exposed to the risk. So that means when they're not completely covered by insurance or when they retain the mortgage on their portfolio. And that this rationing of credit on the intensive margin has real effects, and it shifts the composition of borrowers towards richer and higher credit quality people. So before I get into the details, I have kind of a couple of big picture interpretations of my results. The first is that my results sort of imply that banks do care about their exposures to these idiosyncratic risks coming from floods, and they deal with them in a way that we think is consistent with theory. So that's a positive, but a negative is that sometimes banks aren't exposed to flood risk because that risk is offloaded to the government. And this could be through flood insurance or through securitization. And so for those, banks aren't as diligent about managing their exposures. So that's kind of a negative. And I think one of the takeaways is that banks would likely screen for flood risk in the absence of government insurance and backing, because we see them do this for the mortgages that they're exposed to. I'm just going to go through this very quickly. There aren't that many papers that are exploring the effect of flood risk on mortgage contracting in particular. And the ones that do look at the effect of storms on mortgage terms. So they see the experience of a storm and they look at how mortgage terms change after. I'm looking at two new sources of variation coming from adjustment in response to the changing flood maps and adjustment in response to insurance. And both of those sources of variation are novel. Great, so to kind of fix ideas, there's a question of how we sort of, in a theoretical sense, would expect banks to deal with flood risk. So there's a classic intuition in corporate finance, which is basically the following. When you are worried about strategic default, so this is when you're worried that borrowers who are in a negative equity position, if you're worried about those people defaulting, then the optimal strategy to deal with that risk is to actually ration credit. So the reason this goes through quantities rather than prices is the following. Smaller loan to value ratios would actually lower the probability of negative equity after a flood. If you keep loan sizes the same and you were to actually charge higher interest rates, that would increase the amount that borrowers owe. So that actually increases the probability of negative equity. This is a very specific example of a larger phenomenon where if you have a moral hazard in financial contracts, then the optimal contract requires changing both quantities and prices. This is kind of a specific example of that. So we would expect a lot of the adjustment to flood risk to happen through quantities. That's kind of the first intuition. The second is that some flood damage is going to be offset by payments from insurance. So banks are only really exposed to flood risk when that risk is not insured. So that's kind of the second key intuition. So banks should only respond to uninsured risks. So that's basically the two hypotheses that I test. The first is that loan to value ratios should be lower in areas that are more exposed to flood risk. And that loan to value ratios should only be sensitive to flood risk when the bank is exposed to it, so when it's uninsured. So to answer this question, I merged 9 different data sets that allow me to sort of have information at the loan level. So in particular, I know for each individual, their credit score and income, and I know for that particular loan, the characteristics of the house. I know the property value, the replacement cost of the home, and the geographic coordinates. And then I also know the mortgage contract associated with that home and that borrower. So I know the interest rate, the loan to value ratio, the maturity, and the ex post performance. So this is the delinquency, foreclosure, etc. And then finally, I also know information about flood risk, which I get from FEMA and the National Oceanic and Atmospheric Administration, NOAA. So I know the current and historic flood zones. I know the date that those maps are revised, and I know ex post outcomes. So I know the actual experiences of flood events and the damages that are incurred. So I sort of merge all these data sets and I digitize all these maps, and my final sample covers Florida from 2010 to 2016. So here's just a first cut of the data. On the left, I've plotted just the spatial distribution of flood risk. So this is the average share of a county that's mapped in a FEMA flood zone. So we can kind of see that, as you might expect, kind of the areas around the coast are the areas that have the most amount of exposure. On the right, what I've done is I've plotted the average loan to value ratio for each county. And hopefully what's sort of clear is that these two maps are kind of the inverses of each other. We see that these areas with the largest amount of floods, with the highest share of flood zones, are also the areas that kind of have the lowest loan to value ratios. Obviously, this is just kind of a rough correlation, but this kind of illustrates what I'm going to try to explore further a little bit more rigorously. So the first thing we might be worried about is that the composition of people sort of in and out of flood zones is different. So the first thing I do is just see if that difference in average loan to value ratios goes through if I kind of look at different characteristics of the person. So I have credit scores here. I do the same thing for income and for property values. So what I've done is I've binned people by their credit score group, and I've plotted the average loan to value ratio for people who live in a flood zone, and which is in red, and people who don't live in a flood zone. And basically what you see here is that for each bin of credit score, loan to value ratios are lower. And interest rates are slightly higher, but not significantly so, excuse me. And that delinquency rates roughly equalize. Again, this is the same thing that we see if we do this using income or if we do this using property values. This is just a correlation, but it kind of suggests that at least to some extent, there are differences in the contracts that are being offered. So then I look at whether this average reduction of loan to value ratios in flood zones is sort of different by whether the banks retain the mortgage or by whether they securitize it. So here, even though most conforming loans are eventually securitized, not all of them are immediately securitized. So some mortgages are actually kept on the bank's balance sheets for a year or two before they're ultimately securitized. So those are conforming loans that are kept by the bank or that are sold to an affiliate of the bank. And what I see is that the reduction in loan to value ratios in flood zones is really driven by those loans that are kept on the bank's balance sheet. We see that 2% percentage point number here. For loans that are sold to someone else, so that's either to another commercial bank, to Fannie Mae or Freddie Mac or Ginnie Mae, we see that loan to value ratios are maybe even slightly higher in flood zones than outside of flood zones. So this is consistent with the idea that a lot of the reduction in loan to value ratios is driven by the exposure that banks retain. But obviously those are just rough correlations. So now what I'm going to try to do is I'm going to try to show you, using this natural experiment from updated flood maps, that this is really being driven by banks offering different contracts. So what's really nice about this natural experiment is that the updated flood maps sort of do two things. They change people's assessments of risk. They change people's flood insurance requirements, but they don't change the amenities of an area. the key kind of endogeneity concern, or the key concern that prevents us from interpreting those average differences as a causal effect of bank screening, is that there's this possibility that maybe richer people like to live in coastal areas, and those richer people sort of prefer loans with lower loan to value ratios. That's kind of the endogeneity concern. So the advantage of this natural experiment is that those coastal areas are still coastal areas with the remappings. Those amenities don't change. So this allows us to identify the kind of causal effect of changing risk assessments. And we can see that allows us to see how much of the average difference in loan to value ratios in flood zones is really being driven by banks. And this also allows us to see what happens to the composition of people who live in flood zones. So I run this natural experiment by running, I use this natural experiment by running the following staggered difference and differences design. Basically, I regress loan to value ratios on a county fixed effect, a time fixed effect, and an indicator for the year relative to the remapping. And I'm going to include, for zip codes that are treated, are zip codes that have a new flood map which expands the boundaries of a flood zone. So the idea here is that we want some sort of a shock that makes banks think that those places are riskier. And as controls, I'm going to include zip codes that don't have any new maps. And I'm going to do a robustness check where I look at flood zones that got a new map, but the boundaries didn't change. And so when I run this, I basically find that there are no pre-trends. So in the years before the new remapping, there's sort of no real difference in average loan to value ratios. But then after the remappings, we see loan to value ratios reduced by roughly 2 percentage points. So this is roughly consistent with the idea that banks are updating their risk assessments after these new maps, and they're requiring higher down payments. And then if we look at the composition of borrowers, if we look at the average incomes of those people who borrow using mortgages, we see that average incomes go up significantly. And we also see that average credit scores go up significantly after the new maps. So this is consistent with the story where banks are requiring higher down payments, they're requiring flood insurance, and the only people that can kind of afford those higher down payments are this sort of higher credit quality people. So you might be thinking that, like, what exactly is the shock coming from flood maps? I'm arguing that those flood maps are conveying new information about flood risk, but there's this weird feature where we know that climate change and flood risk is a sort of slow moving phenomenon. So we know that fundamental flood risk hasn't changed with the remapping. So I'm now going to use the second source of variation, which actually comes from this feature of flood insurance contracts, to actually see how banks react to their actual flood risk exposures. So as some quick background, borrowers in flood zones are required to purchase flood insurance, but this flood insurance is capped at $250,000. So basically for houses that are below this cap, banks can expect to be completely insured, but for houses that are above that cap, banks retain some residual exposure to flood risk. And so what I'm going to look at is how access to insurance changes the mortgage contract using a rich set of controls. So what I do is I regress loan to value ratios on whether the house is in a flood zone, and I interact it with an indicator for the replacement cost of the house. The replacement cost of the house is a rough measure of how much it would cost to rebuild that house if it was completely damaged by a flood. And the way I proxy that is I look at the size of the house in terms of square feet, and I multiply that by local construction costs. So that gives me a measure of how much it would cost to rebuild that house. And what we see here is that for houses sort of that are below the insurance cap, the effect of being in a flood zone on loan to value ratios is not significant from zero. But the effect of being in a flood zone on loan to value ratios is negative, and the increasing in magnitudes the more uninsured exposure that the bank has. So this is roughly consistent with the banks requiring higher down payments for their residual uninsured flood risk exposure. And it's suggestive that banks are actually requiring these higher loan to value ratios rather than borrowers sort of choosing lower loan to value ratios. And then just as a kind of robustness, I do this sample split by whether or not the mortgage is retained by the originating bank or whether it's sold to the GSEs. And what I find is that, again, these results that being above the insurance cap leads to lower loan to value ratios, that's significant for those mortgages that are retained by the bank. But we see that loan to value ratios are not significantly different in and out of flood zones for loans that are sold to the GSEs. So there's some kind of positives and some negatives from my results. I find pretty significant results suggesting that banks ration credit to manage their residual uninsured flood risk exposures, and that this changes the composition of flood zones towards richer people. That's a good thing to the extent that we think richer people are better able to bear this risk. And the magnitudes make sense to the extent that equalized delinquency rates in and out of flood zones suggest that pricing is fair. But there are some negatives. I don't find any evidence of screening for loans that can be completely insured or loans that are passed on to the GSEs. So this suggests that the government retains huge exposures to flood risk. So thank you so much. I will stop here.
Great, thanks. Just a reminder, anybody with questions can post them. I'll go in, I have one question for each of you, but I'll go in reverse order, absent getting anything through the chats. So Pari, this is for you. It was interesting that after the new maps got updated, you suggested that the credit quality and income of the borrowers went up. And you attributed that sort of loosely, I think, to maybe the cost, sort of the cost of flood insurance. It's also possible, it strikes me, that higher income people might face more severe consequences to strategic default. So like their credit quality going down more, might be more. Is that possibly true? And is there any way you could think of off the top of your head to sort of tell the difference, or would that matter in terms of how to interpret these results?
Sure, that's a really great point. So I think I didn't show this, but there's sort of two results. I find that loan to value ratios go down and interest rates don't change. And so I think the fact that this isn't a better deal for the borrowers in the sense that they're not getting better interest rates in addition to the lower loan to value ratios is suggestive that it's really being driven by the banks rather than the borrowers. To your particular point about this being driven by people who have higher costs of default, I guess there's a question of why would those people be attracted to a flood zone? Like, why would those people move to an area after knowing that floods are more likely? So I guess that's kind of the story that would have to be happening, and maybe that's possible, but I'm not totally sure about how to think through that, if that makes sense.
Sure, thanks. For Ghassan, it strikes, I'm not sure that my question actually makes sense. So if it doesn't, you should tell me that what I'm saying doesn't make sense. But if I understood your results correctly, there was a consequence to the fact that the carbon price could experience shocks because of the particular choice of regulatory environment that you were modeling, which I think was something akin to like a cap and trade, right? So is there a different way to think about it if instead there was a carbon tax, so the price was fixed and the quantity would respond to shocks? And does that tell us, roughly speaking, people think about cap and trade and carbon tax as being kind of equivalent policies, like there's some version of each that roughly gets you to the same place, but maybe in your framework that's not true.
I mean, thanks for the question. I think it's a very important one, and I think you're raising an important point. You're totally right in the sense that a carbon tax fixed level would yield you in some specific configuration the cap that you would like. But indeed, like one of the major points that we have is the a market design that brings this sort of volatility. So if one thinks about it from a perspective of a fixed tax that would be increasing, that would probably yield the emission decrease, and probably with no sort of like a risk premium distortion, for instance, and that would probably solve the distortion, in which case it just what we see happening in most of the big economies is that most of the regulators are going more toward a cap and trade system than a fixed carbon tax.
Right, thanks. Yeah, and it's obviously a very open question here in the U.S. right now, which version we would pursue. And then one question for David. I thought this was really interesting, sitting as I do in a bank right down the hall from the folks who do the loan pricing. You looked at one piece of sort of ex post performance of the loans that went to the low ESG banks, which is that they seem to have sort of artificially inflated their ESG scores right before trying to get these somewhat cheap loans. I'm just curious if you'd looked at any other differences in ex post performance. Like, is there any way that these companies are different, or are they just getting a great deal in the short run based on their willingness to do business with a low ESG bank? Sorry, you're muted. Just take yourself off.
So your question is basically the loan performance around after giving from given to the low ESG banks, right?
Yeah, because you show that they get much lower yield spreads, and I know you're controlling for credit quality in a bunch of ways that we can watch, but I'm curious if if there was anything about their ex post performance that suggests that they were somehow different from the otherwise similar companies that went to the highest ESG banks.
The untable analysis shows that there is no changes in the performance, both in terms of both loan and borrowers.
And do you have a sense of what this says about the shadow price of an ESG rating for a bank? 20 basis points is a fair bit of, I believe that was roughly what you thought the loans were something on that order of magnitude. It was like 8% or something like that cheaper for the borrower. That's a fair bit. Does that suggests that it seems like a pretty high shadow price of trying to increase your ESG score from the standpoint of a bank?
Right. In terms of magnitude, depends on the model specifications. The maximum impact on the loan spread is 17% of the median spread, which is 229 basis points in my sample. I totally agree with you.
Okay. Well, look, thanks all three of you, and thanks everybody for participating. And I guess I'll turn it over. I'm going to turn over to Debbie to close it up. Thanks.
Great. Thanks, Jeff, and thanks everyone in this session, and thanks to everyone in the audience for joining us. I do want to thank Jeff and Barclays for co-sponsoring this conference. We certainly couldn't have done it without them. So hope to see people at our conference next year, and have a good rest of the day or evening. Take care.
Thank you very much.